You're syncing up and tuning in to the Lending Link podcast, powered by GDS Link, where the modern day lender can dive deeper into the future of data, decisioning, and credit risk solutions. Welcome to the show, everyone. I'm your host, Rich Altman, and today we're diving into a variety of topics with Dan Quan, co-founder and general partner at NevCaut Ventures, including his experience working at the CFPB, the investment landscape of his new company, what industry trends he's expecting for 2023, and so much more. But first, please head over to GDS Link's LinkedIn and Twitter pages at GDS Link and hit those like and follow buttons. Be sure to subscribe to the Lending Link on Apple Podcasts, Spotify, or wherever you prefer to listen to your podcast. As I shared, I'm being joined today with Dan Quan, the co-founder and general partner at NevCaut Ventures, which launched in May 2021 and invests in early-stage fintechs. Dan is also a senior advisor for McKinsey's banking practice since 2018 and an adjunct scholar since 2019 at the Cato Institute Center for Monetary and Financial Alternatives. Dan holds an MA in Public Administration from Harvard's Kennedy School of Government and an MBA from Drexel University's Bennett S. LeBeau College of Business. Dan also sits on several advisory boards, including PayActive. All right, now, let's get synced with GDS Link. Good afternoon, Dan, and welcome.
Thank you for having me, Rich.
I want to thank you for joining the Lending Link today. I'm really excited to have you with us. Where are you joining us from today?
I'm actually in the sunshine Jacksonville, Florida. No hurricane. Everything is very peaceful here.
Before we jump into the business side of things, I always like to get started with a little personal opportunity to learn more about our guest. You shared with me that you were born in China and you moved here in your 20s. Can you share any specific feelings you had when you first arrived in the U.S.?
What do you call FOB, right? First, fresh off the boat. And even though I did study and learn English for, 10 some years in China and still speaking the language as a second language, when you constantly had to do the translation in your head before you open your mouth, that was a challenge. And English is still, quote unquote, my second language. It's not my mother tongue. But I think over the years, the translation process became not noticeable anymore. And someone actually told me that when you speak English in your dream, that means you have already been, sort of mastered the language already. But I did a few times, a couple of years after I arrived in this country, in my dreams, I was speaking English. So I guess I already arrived at that point.
You also shared with me that you enjoyed traveling. If you could only go back to one place that you've been to before, where would that be and why?
Bhutan, definitely Bhutan. For anyone who has never been to Bhutan or don't even know where that country is, it's a tiny, tiny landlocked country between China, Tibet, and India and Nepal, I think. Yeah, I think they border in Nepal a little bit. Anyway, it's quite expensive to actually be in the country because they actually has a daily minimal spending for foreigners because they want to actually keep the country pristine. But they're very friendly people, very friendly, government there, but beautiful scenery. But it's really beautiful, very, very peaceful, tranquil.
I'll add that to our bucket list. My wife and I just got back from Greece and Turkey recently. We had a great time there. Well, thanks for sharing that. I always think it's good to see the human side of my guest. But let's get down to business now. Clearly you have a very diverse background, having worked both in the private sector as well as the public sector. Today, I'd like to start off discussing some of your work at the CFPB. I see from your LinkedIn profile that before you joined the CFPB, you were a research associate at the Harvard School of Business. Can you share the type of research you did and whether this work was a catalyst for wanting to take a role at the CFPB?
So I was a research associate at Harvard Business School and was working for a professor. His name is Peter Tufano. At that time, he was a senior associate dean at HBS. And he was actually about to leave and became the dean at SIE Business School at Oxford. So that was his last year at the HBS when I worked for him. And I was in my mind, my math is pretty good, not top notch, but pretty good. So maybe a PhD in economics is something that's being sort of always appealing to me. So that's how I became his assistant and helping him with the research. So another interesting thing is in those days when you think about finance at elite schools like HBS, it's all about investment banking, hedge fund, PE, VC. Nobody thought about Main Street consumer banking like credit cards, debit cards, loans, mortgages. But Peter was the first one that actually introduced a consumer finance course to business school, not just in sort of top ranking schools, but business school, period. And I didn't know much about consumer finance, even though I did have a credit card, credit cards, not just one credit card and account, checking and savings accounts. But he really sort of taught me about these things, which are frankly quite foreign to me when you actually dug deeper. So one day he asked me, do you like teaching? And I said, not really. So do you like doing research? I said, well, not really. He said, well, why are you wasting our time and money to make your PhD candidate? And I was like, most PhD students end up in Wall Street or elsewhere, not in academia. He said, well, at least on the application, they're saying they want to be professors.
Right.
So essentially, I said, well, I'm being penalized for being honest with you. How about this little agency, new agency called Consumer Financial Protection Bureau, and he was actually helping them on some of the efforts as they were starting up. And go check them out if you're interested. I'm happy to make a connection for you. So that's how I actually moved from Boston to DC. Now thinking about the work that I later did at the bureau, actually for the majority of my time I did in the bureau, which is about innovation. In 2010, either 10 or 11, he and a bunch of other professors actually wrote a letter to then director Elizabeth Warren, now Senator Elizabeth Warren, actually strongly urging her not to just simply focusing on enforcement tools and supervision tools to sort of get rid of bad actors. They encourage her to really think about innovation, which is something that policymakers and regulators, at least at that time, nobody was even thinking about that. The sort of softer approach, right? So the idea is enforcement and supervision are very effective, but blunt tools to get rid of bad actors. But at the end of the day, financial regulation basically only serves as the minimum threshold that everyone has to abide by, right? So it's the minimum standard that you have to comply with. But how do you encourage firms to go beyond that? And you can actually kill or ban all the bad actors. But at the end of the day, consumers still need a good financial product to use, to live by. So they strongly encourage her to really think about ideas like innovation. And I shouldn't say that letter was the catalyst for Project Catalyst, but that definitely served that, I think it was one of the reasons. And Peter, later on, after I took that job, actually, he was already over the pond at Oxford. I reconnected with him, and he said, well, I should take credit for the job you're holding today.
Yeah, so that was around 2012 when the CFPB announced Project Catalyst.
Yeah,
and I think you kind of talked about the mission that was around innovation. Any other tenets that were the key objectives for Project Catalyst? I know one of the big things for the CFPB is all about financial inclusion. So was that one of the key tenets as well that you could talk to?
Someone at one of the largest financial firms actually told me, this was when I was at CFPB. He said, well, you guys are taking a very sort of, for lack of a better word, casual approach when it comes to interacting with us. Casual, not in the sense that you're being not serious. Casual means you're being approachable. Maybe approachable is a better word. So he gave me an example where how they engage with another agency whose name I shall not mention. He said they have to go through first step has to go through their examiner. The examiner would relay the request to the field manager. Field manager will relay the request to regional director. The regional director will contact the senior staffer in DC, in the headquarters, to help set up the meeting. So from the time they want to have a meeting with the senior staffer in DC till the meeting happens, typically 2 to 3 months. Whereas the CFPB with us was much, much faster. And we realized this is something we should be doing more as an agency, because everybody lives in their own bubble, especially in Washington D.C. You don't know what's going on outside the Beltway. And when we started seeing innovation popping up, everywhere after the financial crisis, when the incumbents basically retreated, right? So all of a sudden, this new thing called fintechs came up, right? Remember, in the days, Lending Club was Lending Club of Prosper. They were the first innovative companies that really eating the incumbents' lunch when it comes to lending and personal loans.
I recall that Prosper rolled out first, right? And really had some challenges
Prosper.
Getting the regulators to understand who and what they were.
Yeah, they
And-
were shut down by the SEC, and the
right.
lending club voluntarily ceased their business for a year. So all these earlier pioneers had challenges, all sorts of challenges with regulations. And I think it's a good thing that the bureau's leadership back then, Director Cordray, he realized this is something we need to fix. So how do we do that, right? So the first thing is really about information gathering. There's a huge information gap. The startups or the guys who wear jeans, they have no idea what kind of regulatory expectations they should meet. But those who are like, the CFPB and the other agencies who are writing the rules, who are enforcing the rules, also do not understand how these rules are affecting these sort of innovations. Are they helping them? Are they hurting them? So I think that was one of the reasons Project Catalyst or Office of Innovation later on it was called, was created, just to gather information, just be approachable. Really, back in the days, we actually had a sort of informal dress code when you meet with these guys, especially when you go to San Francisco or other cities, New York. You have to wear jeans. You don't wear a suit, don't wear a tie because you're going to scare people off. But of course, when the initiative was first launched, the mission was to promote consumer-friendly innovation, right? But it's a very vague term. But in reality, what the first thing we did was just trying to get people to talk to you, because people are afraid. People are very, very afraid, especially as you know, in the early days of the CFPB. There was a lot of negative press coverage about the bureau. It was a hard job just to make sure people are willing to sign up and to meet with you and to later on divulge information that you otherwise will not be able to hear.
So undoubtedly, a lot of our listeners today are familiar with the initial no action letter that was issued to Upstart. So in 2017, they were issued the first no action letter, which was related to the use of alternative data in making credit and pricing decisions. I could actually remember reading some of the papers on alternative data surveys that were done. And then a second letter in November 2020 was related to the use of AI and machine learning in model development. And then 2022, Upstart actually requested that the letter be terminated. When you look back, can you share the positives that you feel came from these no action letters? And what were some of the lessons learned as you and your team evaluated the extension of other no action letters at the time?
So if you go to agency asking a question, most of the times they actually will stay silent. They will not tell you whether it's legal or in compliance. They will just don't tell you anything. The reason being they are afraid to tell you something that could be, interpreted as something like a blessing or endorsement. And also, most of the times they just do not know the answer. And I think the no action letter tool was really initially designed just to try to really bypass that problem, right? So if you look at the policy basically doesn't say yes or no. The policy just says, again, very vaguely, the CFPB will not take adversary actions against you. But of course, the Bureau will have the authority to, rescind the letter. So we saw the use of AI and machine learning and the use of alternative data that can potentially expand access to credit. And the CFPB has done lots of research in that, right? The credit invisible, the term was basically coined by the CFPB research group. But now, is there any regulation that specifically bans the use of AI and machine learning or alternative data? The answer is no. Everybody is concerned about, obviously, discrimination or disparate impact, but the regulation doesn't say you shall not use certain data unless it's expressly prohibited by the law, right? It's like age, gender, and the other protected classes. So there's a lot of hesitations. I personally feel the letter has already served its purpose. But what I really wanted to see actually when I saw the second letter coming out, I actually would want the CFPB to write something, to issue something that's broadly applicable to the entire industry, not just specifically to a company, right? Like Upstart. I really hope that no action letter is nothing but a tool. It's not the end game, right? The end game is how can you really learn from these experiments, these tests, and figure out a way to provide broader guidance to the industry so that everybody can benefit from it. But at least there was an experiment. There was lot of empirical evidence that shows machine learning and the use of non-traditional data, if properly supervised and managed, does have the ability to expand access to credit without triggering any kind of negative consequences that the lenders are afraid of.
Yeah, I mean, I know that you talked a lot about when you and I chatted before about open banking data, and certainly we've seen explosive growth, right, in that use of data, and certainly it's allowed for a lot more inclusion of consumers that otherwise might have been denied. Kevin Moss and I talked a lot about that on the last podcast. But you mentioned Dan, disparate impact, and that's a topic that is often talked about. I still think there's confusion in the market. I'll ask people in the world to say, explain to me what disparate impact really means and how do you detect it. So, when we think about machine learning and AI in particular, do you feel that the application of those tools is doing a good job to ensure that there isn't disparate impact? And is it really something easy to determine?
It is not easy to determine, frankly. It's a very, very difficult. And if you look at the sort of still prevailing practice of how lenders do disparate impact testing, it's a very much a manual process, right? You hire lawyers, you hire those specialty firms that have lots of expertise, and they have economists with PhD degrees, crunching numbers, developing models, and do the swiping, swipe out. And it's a very, very labor-intensive exercise, and I don't think it can really go scale. And the lenders are scared of it. So if you look at the original intent of Equal Credit Opportunity Act, the ECOA or ECOA, there were actually two purposes. One was really try to ban the discriminations. Things like women shouldn't get credit, right? Back in the days, that was the norm. Now it's like, oh, that's definitely illegal, right? Black people, people of color shouldn't get credit. That's definitely illegal. But back in the days, that was the norm. So that was the first thing the act was trying to fix. The second thing, which actually over the years and decades since the ECOA was passed, nobody really paid attention to it, which is really how can we really unlock the credit box, expand the credit box so that more people can benefit, get access. That's really an important factor for people to move up the social ladder. So as a result, I think lenders just become extremely conservative. They stick with the playbook that they're used to,
Right?
And they're afraid of making any changes. And the result is still one of the wealthiest country in the world. We still have over 40 million Americans who are credit invisible. That's a shame, really a shame. And the machine learning obviously can help solve that problem. Does it solve all the problem? I don't think so. But actually, that has the potential to really open up the credit box. But it's not a panacea. It doesn't cure all the problems for sure.
Right.
But machine learning definitely can really help solve some of the problem. The positive side is that regulators are aware of what's happening, and there are lots of groups that are trying to do research to get a better understanding how AI ML can be helpful. And you saw a couple of weeks ago, the White House published a Bill of Rights for AI, which I think is all positive, right? Nothing earth-shattering from the document, but actually that lays out some very good sort of principles how not just financial services but generally companies should private sector companies should pay attention to when they adopt AI and ML. But I think at the end of the day, everybody's concerned about discrimination. Nobody wants to discriminate, right? So I think regulators need to really provide a better guidance, a roadmap for compliance. And I'm not really banking on any agency in the near future to issue such guidance. I know the agencies tried in the past and they really try to collaborate with each other. But I think at the end of the day, they're doing what I call a job that's like mission impossible. The reason I'm saying that is, unlike most of the regulations in the United States, when it comes to fair lending, disparate impact, it's very much principle based. So the rule doesn't say, here's a red line, don't cross it, right? There's no red line. So you don't know until you get a CID or you get an investigation. Right. That'll be too late.
There's always that level of uncertainty on how far you're straying. Yeah, interesting.
Exactly.
So, kind of wrapping up on the CFPB, there's been a lot of news about the CFPB over the last couple of weeks. And in fact, this week they announced some rules that they're looking at related to 1033 and the personal financial data rights. What are your thoughts on that? Is that something that we'll see come about? I mean, I understand that really about giving consumers a lot more control over their data, creating a lot more competition. I read an analogy that talked about the portability of phone numbers and how that law allowed people to easily switch from Verizon to T-Mobile, and that the goal here is really to allow consumers to more easily hop around if they're not happy with the service they're getting from a particular financial institution. Your opinion on, when do you think we'll really see a reality of that happening with the rules?
Well, I'm not sure if the rule is ultimately going to be able to achieve that. I think switching phone number, switching wireless provider while keeping a phone number is a much easier task than switching your depository institution while keeping your direct deposits and payroll and all the other bill pay information intact. I think these are two different things, very different, similar in theory, but the latter is much, much more complicated. And I'm not sure the rule will actually achieve that, but the rule definitely will set up a regulatory framework such that when consumer permission third party to access their data on their behalf, as if they were the one that access their information using their mobile app or their online banking portal. I think that's really the first step. Back in 2016-15, when we saw open banking, PSD2, open banking in the UK, and it's PSD2
Right.
in the EU, we realized that, in the United States, we don't have any of these rules or regulations or sort of mandates, but we have this thing called 1033, which is something that most people didn't even pay attention to. But on the other hand, I think the United States has always been at the cutting edge when it comes to data sharing. I recall 6 years ago, around this time, Director Kodre went to Money 2020 and delivered a speech. And toward the end of the speech, he basically said the data belongs to consumers and they have the right to share with third parties. So that was the first shot he fired.
Right. Across the bow.
Across the bow, exactly. And 6 years later, the agency is moving on to a official rulemaking. I'm very, very happy, even though it's, I wish this could go faster.
Well, we're going to take a moment to virtually take off your public sector hat and put on your private sector hat and talk about your new business, NevCaut, that you launched in May 2021. Interesting name. Why don't you share a little bit? What does NevCaut mean?
Well, obviously, as you mentioned earlier at the beginning of the show, this venture fund really focuses on early stage fintech, insurtech startups. So for anyone to invest in that stage, you got to be bold. You got to be willing to take a risk, not just startup founders, but also investors. And we happen to be in the camp, and we'd love to roll up our sleeves and fight in the same trench with the founders that we support. And we want to be bold. So we want to be cautious, of course, but we don't want to be too cautious. So NevCaut is kind of never cautious, but we're still very prudent with our LP's money, that's for sure. But we have done some very, very good deals, and we're happy with the portfolio we're building so far.
As you evaluate companies, you list out the different firms you're involved with on your website. How do you feel that your experience at the CFPB is affecting or impacting what companies you decide to invest in? One of the companies you've invested in is Fairplay, which is about fairness as a service. So, maybe kind of talk about what's that influence that the CFPB days for you have had when you're looking at firms that you might invest in.
I think at the high level, I think VC business is more or less an insider business, right? So you know the network, you know where to find the deals, you build your network, you build your name, you build your brand, so that founders want to work with you. What they seek from you is not just a check; they actually want advice. So I think a lot of the work that I've done at the CFPB, some of the pioneering work in the use of data, machine learning and AI, as well as open banking, that really has translated into very valuable advice to founders that we invest in the founders that we work with. Glad you mentioned Fairplay. So, this is really sort of a continuation of my previous work at the Bureau on AI machine learning and on disparate impact, which we just talked about. And I think Fairplay really, their solution really is revolutionary in the sense that a lender can really do disparate impact testing on demand. You no longer need to hire expensive lawyers and consultants to help you, and it will take them 3 to 6 months. This one, if you use their software, you can do it within, a couple hours, and you can do it constantly. And this is something actually, when we first worked with Upstart, we were wishing that there was some kind of solution like this, because you think about it, the lender doesn't know he is, violating a COA until after the fact, right? Because before the loan is issued, you have no idea whether you're in compliance or not. And even if today or after, you look back for 6 months, you are in compliance, that doesn't guarantee you in another 6 months, you are still in compliance.
Right.
So ideally, regulators should require lenders to do constantly testing of their disparate impact compliance, but no lenders does that because it's very, very expensive. And I think Fairplay can really do that. And I think just beyond just lending, fairness in doing business is about marketing. It's about insurance as well. So I think the application of their software really goes beyond the purely disparate impact testing, which is obviously it's very, very technical and hard for people to understand, even for investors. The third thing I think about Fairplay that sort of got us excited is really, and we talked about this, Rich, earlier at the show. For folks like you and I, whether you use fancy machine learning tools or the alternative data, the result from lenders' perspective will be the same. We probably get the best interest rates, the largest line we can see, right? But for the people who are actually on the edge, the results will be very different. And you don't know whether a 600 FICO is necessarily better than 580 FICO.
Right.
But if you purely look at using traditional regression model and traditional data sources, 620 probably is a better risk than 580. But I think once you apply machine learning, you may see a different results. And I think their second look product is going to be if they can prove their accuracy. I think lenders will find it very, very useful for them to really, again, more precisely manage the portfolio risk, and at the same time without increasing the default risk, and open the credit box to allow more people to get credit.
Interesting. Yeah, so I kind of think about Pagaya and Theorem, right, that are second look lenders, but this would be an opportunity for the first look lender to go deeper by looking at these type of opportunities. I'm sure you're familiar with Nova Credit, right? I mean, they've
I'm actually
done a
investor in Nova Credit too.
So Nova Credit, for our audience, they've built a platform that helps people immigrating or immigrants in the U.S. Get access to their traditional credit file somewhere else in the world. And they've formed alliances with several companies. They're doing a real great job. So this might be a little bit of a personal question, but I think about your involvement with Project Catalyst, your role as an adjunct professor with the Center for Monetary and Financial Alternatives, Fairplay. I get the feeling that you're kind of on a mission related to financial inclusion and fairness in lending. Would you agree with me? And can you share why you're so passionate about this subject?
And the answer is yes, it is. When we raised our fund, 18 months ago, financial inclusion is one of our core theses for the fund. And obviously, as an investor, we ultimately want to return the capital to the LPs with multiples on it, right? Hopefully. But we do really believe that with the power of technology, financial innovation, I think financial services can be more fair, can be more inclusive. And at the end of the day, as investors, we can make a lot of money by doing good things. So probably just as a new immigrant to this country myself, right? I lived through poverty myself too. I had a time when I had to borrow a lot of money just to maintain my lifestyle because lost my job. I couldn't, without a loan, I wouldn't be able to survive another week, another month. So I was keenly aware of how important the access to credit is, just purely through personal experience. And also, I can still remember the first time I got a credit card. I had no idea what credit card was when I first, moved to this country. I kind of had some idea of a debit card, but never used debit card in my life before that. When I was in China, so credit card was like, wow, I can borrow money on this piece of plastic. It's amazing. It is. I cannot describe to you how much joy I had when I opened the envelope and some kind of institution, I think it was MBNA, which doesn't exist anymore, give me a card and believed in me that you can spend the money responsibly and pay me back, right? Because I was a thin file, no file at that time. I can tell you another story where we led a deal, investing company called Funded, right? So Steph Samples is the founder CEO. The mission of the company is just trying to provide the credit to women-owned small businesses,
right?
Which is hugely neglected. And when she sort of described to me, when she had a pitch to me, and that sort of what she described to me as she herself has been a small business owner all her life. My personal experience as a consumer, sort of, fresh off the boat and trying to get credit, I can very much resonate. And I really believe that credit can be more fair and the credit can be more open and more people can benefit, small businesses can benefit from it. And what we need is really right investments, right founders, and right regulations.
Well, it's interesting. Maybe if more people saw opening that credit card as a privilege and not as a right, they might behave better on how they make those payments. So, kind of wrapping up on the business side, as you think about firms that you might be investing in, companies that are out there looking for capital, obviously we're in a lot different market today than we were
Yeah.
6 months ago, 12 months ago. Any advice that if you were about to interview a startup, what is some advice that you might give them when they're about to come on the NavCaut Shark Tank?
Well, I think the first thing is lower expectation.
Right.
Lower expectation, and don't feel offended when the VC pushes back on the valuation. I think we got a lot of the pushback, a few months ago, but I think now a lot of funders they kind of sink in with the reality. It is a different environment, and you really be prudent with the money that you want to seek, from investors. And I think the winter's here, and the winter is here to stay. It's not going to be I'm not talking about the recession or pending the pending recession or anything. It's really about just the winter in the funding market. The private market is not going to recover anytime soon. We'll continue to see low multiples, depressed valuations, and unfortunately, good ideas not getting funded, and they just go belly up. That's very unfortunate. I think, as this as well, a lot of VCs are really hoarding cash and sitting on the sidelines. And I think hopefully, in 6 to 8 months, we'll see some kind of loosening there, and VCs are more willing to deploy capital, because at the end of the day, right, LPs give you money not to sit there idle and collecting management fees. They want you to invest.
Right.
I think that's going to change, but I'm not sure how quickly the change will come.
Well, I guess if you could get that capital today, you're going to have, as you say, a far stronger selling position.
I'm glad you mentioned that. So another advice I always give to startups that we work with is, if someone's willing to give you money, write your check, take the money now. Don't worry about dilution, unless it's ridiculous terms, right? But most VCs are being reasonable. They're not. They may be aggressive. You'd rather be owner of 1% owner of a $1 billion company than 100% owner of a failed business.
Right. Exactly. Good, great. Well, this is Rich Alterman, your host of the Lending Link, and talking to Dan Quan of NevCaut Ventures and a prior member of the CFPB. Dan, thanks for joining us today. Hope you've enjoyed this as much as I have, and maybe we'll have you back sometime in the future. And good luck with your new company.
Thank you for having me, Rich.